Welcome back to the Daily Crypto Deep Dive. Today's deep dive is about one of the most important mental upgrades you can make as a market participant. And it's something that separates people who survive cycles from people who get emotionally shaken out of them every time volatility hits. We're talking about the difference between triggers and causes, and why confusing the two is one of the fastest ways to lose clarity, confidence, and capital. This week is the perfect example. Bitcoin pulls back into the low $90,000 range. Ethereum slips toward $3,200. Headlines immediately point to Trump's tariff comments. Social media runs with it. Tariffs cause the crash, macro shock, risk off. And just like that, a clean narrative forms. Before we get into it, regular listeners will know we've gone ad-free again for the time being, because we wanted to keep the focus on clear, uninterrupted analysis. If you're finding value in these episodes, the simplest way you can help keep it that way is by leaving a 5-star rating on the podcast. It genuinely makes a difference. It helps with visibility, growth, and keeps this sustainable without loading it up with ads. Thanks for sticking with it, and for supporting what we're building here. Now getting back to today's analysis. But here's the uncomfortable truth. Most market moves are not caused by the headline you're reading. They're revealed by it. The headline is the match. The market structure is the gasoline. And if you don't understand the difference, you end up reacting to smoke instead of understanding fire. So today, we're going to break this down properly. We're going to explain what triggers are, what causes are, how markets use headlines, why crypto is especially vulnerable to this confusion, and how you can tell in real time whether a move is mechanical or fundamental. This isn't theory. This is practical survival thinking. Let's start with the definition that matters. A trigger is an event, headline, or data point that initiates a move. A cause is the underlying condition that makes the move possible. Triggers are visible. Causes are structural. Triggers are loud. Causes are quiet. Triggers explain timing. Causes explain magnitude. Markets don't fall because of news. They fall because they were already fragile, and the news gave them permission. That's the first mental shift. If Trump's tariff comments had come out last month when leverage was low, positioning was neutral, and price was far from resistance, the market would have shrugged. Maybe a red candle, maybe some noise, and then back to business. The reason this week's comments mattered is because they arrived at the wrong moment. When Bitcoin was extended, leverage had quietly built up, and the market was leaning the same way. Markets don't react equally to the same news at all times. The same headline in different structural conditions produces completely different outcomes. That's why relying on headlines alone is so dangerous. Now let's talk about how markets actually process information. Most people imagine markets as rational systems. News comes in, traders assess it, price moves accordingly. That's not how it works in practice. Markets are reflexive systems. They're dominated by positioning, leverage, and feedback loops. News doesn't instruct the market, it interacts with it. When positioning is light and liquidity is deep, bad news struggles to move price. When positioning is crowded and liquidity is thin, any news can cause outsized moves. This is why you'll often see markets ignore terrible news during bull phases, and then collapse on seemingly minor updates during fragile phases. Crypto magnifies this effect because it's highly leveraged, globally traded, and trades 24/7 without circuit breakers. There's no overnight pause, no opening auction, no stabilization window. When something breaks, it breaks immediately. So let's apply this to what happened this week. Bitcoin had pushed aggressively toward the mid to high $90,000. Funding rates were elevated. Long positioning was crowded. A lot of traders were leaning on the same thesis, continuation higher. That doesn't mean they were wrong, but it does mean the market had become one-sided. In one-sided markets, price doesn't need bad news to fall. It needs an excuse. Trump's tariff rhetoric provided that excuse. Risk sentiment wobbled. The dollar firmed. Bitcoin slipped through a short-term support level. That was enough to trigger liquidation engines. Once those engines fire, price movement becomes mechanical, not emotional. Forced selling takes over. Stop losses cascade. Liquidations beget more liquidations. At that point, asking, "Do tariffs matter?" misses the point. The move is no longer about tariffs. It's about leverage unwinding. This is why professional traders obsess over liquidation data, funding rates, and open interest. They're not predicting news. They're measuring fragility. Now let's be clear about something important. This doesn't mean macro doesn't matter. It means macro sets the background conditions, not the day-to-day candles. Tariffs, rates, inflation, geopolitics. These influence liquidity, risk appetite, and positioning over time. They don't usually cause instant collapses unless the market is already stretched. Think of it like a fault line. Tectonic pressure builds quietly for years. The earthquake happens when stress reaches a threshold. The trigger could be anything, a small shift, a vibration. But the cause was long-term pressure. Markets work the same way. Now here's where most people go wrong. They see the trigger, assume it's the cause, and then extrapolate. If tariffs cause this, what happens if tariffs escalate? If this news caused the drop, what if more news comes? That line of thinking leads to fear-based decisions because it ignores structure. The correct question is, did the move change the structure? If the answer is no, if long-term holders aren't selling, if exchange balances aren't spiking, if spot demand remains, if support holds, then the move was likely a flush, not a reversal. And this is where crypto investors repeatedly get trapped, because crypto headlines are dramatic. They're emotional. They're amplified on social media. They create urgency, and urgency is the enemy of good decision-making. Let's zoom out and talk about historical examples, because this pattern repeats endlessly. In March 2020, when COVID headlines exploded, Bitcoin collapsed over 50% in days. Most people said COVID killed crypto. That wasn't true. Crypto didn't die because of the virus. It fell because global markets were deleveraging, liquidity vanished, and everything that could be sold was sold. The cause was a global liquidity shock. COVID was the trigger. What happened next? Once liquidity returned, through massive stimulus, Bitcoin entered one of the strongest bull markets in history. Same asset, same virus, completely different outcome. Why? Because the structure changed. In 2018, when China banned ICOs and exchanges, people said regulation killed crypto. But regulation didn't cause the bear market. The cause was that the 2017 bull market had become a speculative bubble with no marginal buyers left. Regulation was simply the pin. In 2022, when Terra collapsed and FTX followed, people said crypto is a fraud. But the cause wasn't fraud alone. The cause was a massively over-leveraged system built on cheap money. Once rates rose and liquidity tightened, the weakest structures failed first. The failures revealed fragility. They didn't create it. This distinction matters because it changes how you behave after the move. If you believe the trigger is the cause, you expect continuation. If you understand the cause, you assess whether the damage has already been done. Now let's bring this back to the present. This week's move flushed leveraged longs. It did not trigger mass spot selling. It did not produce long-term holder capitulation. It did not break the broader structural trend. That tells you something. It tells you this was a positional reset, not a conviction shift. And here's where the deeper lesson comes in. Markets often need triggers to do what they were already going to do. They don't wait for perfect reasons. They wait for moments of vulnerability. This is why good news often marks tops, and bad news often marks bottoms. At tops, everyone is positioned bullish. Good news arrives. There's no one left to buy. Price stalls. At bottoms, everyone is positioned bearish. Bad news arrives. There's no one left to sell. Price stabilizes. The headline is the excuse, the positioning is the reality. Now, why is crypto especially prone to this confusion? Because crypto markets are young, narrative-driven, and retail-heavy. Many participants don't have frameworks for structure. They trade stories. They trade emotion. They trade immediacy. Institutions trade differently. They don't chase headlines. They fade them, if structure allows. This is why you'll often see institutions buying into weakness created by headlines, while retail sells in fear. Not because institutions are smarter, but because they're operating on different time frames and with different tools. Now let's talk about how you can actually use this understanding, instead of just nodding along. The first practical upgrade is to ask a better question when news hits. Not, is this news good or bad? But, is the market fragile or resilient right now? If the market is fragile, small news causes big moves. If it's resilient, big news causes small moves. The second upgrade is to watch what happens after the headline, not during it. Does selling accelerate, or does it stall? Do bids step in? Do liquidations exhaust themselves? Does price reclaim levels? Triggers create volatility. Causes create trends. The third upgrade is to stop anchoring decisions to narratives. Narratives are for explanation, not prediction. They help you tell stories after the fact. They rarely help you act correctly in the moment. Professional traders don't say, tariffs are bad, sell. They say, is this move breaking structure or flushing leverage? That difference is everything. Now let's be honest about something uncomfortable. This way of thinking is harder. It doesn't give you clean answers. It doesn't tell you what to do in bold text. It requires patience and observation. That's why most people don't do it. But it's also why most people get shaken out repeatedly. Markets are not out to trick you personally, but they are structured in a way that rewards those who understand fragility and punishes those who react emotionally. If you take one thing away from today's deep dive, let it be this. Headlines don't control markets. They activate them. The real power lies in understanding what the market was already prepared to do. This week's tariff headlines didn't cause crypto to drop. They revealed a market that needed to reset leverage. And once that reset happens, the next move will be decided by structure, not by yesterday's news. That's how you stay grounded when everyone else is panicking or celebrating. Drop your thoughts in the comments. Tell me whether you usually react to headlines or structure, and whether this way of thinking changes how you see this week's move. And if you want to be in with a chance of the XRP giveaway, make sure you comment as well. We'll see you at the top.